Hi guys, welcome to this Moneycontrol live stream. It's Friday the 13th and we are doing this special coverage on the escalating conflict in the West Asia. Israel has carried out preemptive strikes on Iran in the early hours. In fact, Israel says that the strikes were necessary to prevent an imminent attack by Iran. And a special state of emergency has been declared in anticipation of a retaliation via missiles and drones. Now, there is the threat of a larger regional conflict, and this escalation is of greatest concern to the shipping, in Middle East Gulf and adjacent waters. Now, this could effectively close the Strait of Hormuz, at least for a period of time, and that could drive up oil prices. Oil prices, meanwhile, have surged over 13%. Brent is above that $76 per barrel mark. In fact, it has turned positive for the year as well. To understand the implications on the commodities market, how the equity markets will behave, and whether or not this conflict will be short-lived, or are we looking at a protracted war-like situation, if you will. But joining me is Peter McGuire, CEO of Trading.com, and Mayuresh Joshi, Head of Equity Research at William O'Neill India. First and foremost, Peter, coming to you, where do you see this conflict heading? And what are the chances of a retaliation by Iran? In fact, it's not like what are the chances. It's not like, what if. It's like a when now. It's a question of when. So how do you see this playing out, firstly?
Well, good afternoon, Nandita. I think a couple of things. First off, if you're looking at, there is no doubt going to be, I think, some form of retaliation, naturally, as you mentioned, from Iran. And what time scale is that going to be over? Is it going to be short, in the sense sometime today, or is it going to be over the weekend, or is it going to be, sometime over the next week? And do we see further attacks from Israel in that point of time? You mentioned also the Strait of Hormuz. That's a very delicate waterway, and we know of probably the most important choke point as far as crude oil, and you've only got to look at it on a map and what that can do from a Persian Gulf sailing into the Strait of Hormuz. And if that gets blocked, you've got, upwards of 30% of all crude across the globe being transported through that waterway. So that could really push prices significantly higher if there was to be some form of restriction on shipping being able to sail through there.
But how dangerous would a shutdown really be for global oil supply? At the current juncture, in terms of oil supply, we have a surplus. Going forward, how much of it will get impacted?
Well, I think there's a surplus because there's no geopolitical concerns, and you've got excess supply coming from OPEC, and we all understand the current situation. But if this would change the global dynamic very, very quickly if there was a choke point, Nandita, and you actually couldn't get crude in or out of there. So this is the challenge that we face. And if this is where some form of retaliation, it could be Iran might say, well, let's first off look at the waterway, and then secondly, that because they know that impacts global, and then that would drive prices higher. That'd be better naturally for them from an export-driven model, and how that's going to impact naturally Israel if they were to fire into there. And then I would think you could see the US involved in some capacity.
But, you pointed out that the US will be involved in some capacity, but, they have distanced themselves from the conflict. Will they be able to stay out of this, and for how long? Because, Israel claims that they had, of course, intimated the US before carrying out this strike.
Well, President Trump has said that he's not prepared to back Israel on this whole matter, Nandita. But the second part is that there is US ships in that area. And I'm thinking, as far as being involved, I'm talking about keeping that waterway open. So that would be the first part of it. Now, if that was to be protracted and then there was an attack on something like a US ship or something with a US flag, then that would really create hostility. And I'm sure that may in turn bring the US into it. I put my mind back to 86, and when we were trading futures then on the US Bridgeton, which was attacked in the Strait of Hormuz. That's nearly 40 years ago. So it's anything's possible when you're looking at the Strait of Hormuz.
Okay, let me also get in Mayuresh into the discussion then. Mayuresh, it's been, a couple of days of bad news, right? Of course, yesterday the markets were down in the wake of, the conflict that was boiling out in the Middle East. Then there was this whole tariff uncertainty as well, with Trump saying that he will be writing to nations with revised tariff rates, and it will be like a take it or leave it. And then later in the day, we had that big, tragedy with the Ahmedabad plane crash, right? Mood has been somber, and this morning, Nifty has seen a sizable cut as well, 219, 20 odd points down on the Nifty. How are you looking at how this conflict will play out for the Lal Street? Because, we did a money control poll as well, and their market participants had pointed out that Middle East tensions could be one of the biggest risks to the market. Your thoughts?
Morning, Nandita. No, I think till this point of time, I think the markets were probably presuming and assuming that even within the Middle East, this will largely be contained between Israel, Hamas, Hezbollah, as we've been seeing in the past. But I think these preemptive attacks now in Iran and how Iran reacts and what kind of an escalation does that have in terms of that entire region at play. Does the US get involved at some point of time? Does Iran get backing from its proxies as well and its allies? I think this can get blown out. But again, I think it's the next few days and weeks which will determine how this probably shapes up. Obviously, I think as you rightly pointed out, there were already tensions as far as the geo-economic front was concerned related to tariffs, global growth. On top of that, I think this geopolitical news has probably created some element of upside risk as far as risk on asset like equities are concerned. And therefore, I think there might be a risk of trade, at least for the next few days, next few weeks, unless we see clarity, at least on this geopolitical front.
Sure. Peter, let's talk about oil prices as well. Of course, spiked 13%. Brent is above 76. It has turned positive for the year. Not long ago, we had sub 60 levels on Brent, right? In the coming days, how much of an upside are you envisaging? And would you expect the spiral to be short-lived? Or would you say that, you can expect prices to go, north of $100, $120 as well, if this crisis continues for longer?
Well, first off, it comes down to a time frame, and if it was to be short-lived and it's over by the weekend, and which I don't think is going to happen, then I think prices would start to ebb back down. But if this is going to be protracted and it's going to be a tit for tat, and if it was to be significantly ramped up from Iran's side of it, then there could be a super spike as far as crude prices. They might go up another 10%. I mean, they're up, as you mentioned, Nandita, they've been up 13%. They're about 9%, 10% at the moment. It's incredibly volatile. I'm waiting for New York to open, the impact that naturally has to the NYMEX and the flow-on effect there. So it could be a very significantly price-wise big spike. And I've just got to see the time scale and what that more or less dictates as far as price. It's all about hostile. It's all about keeping shipping open. There are many moving parts to this. And the uncertainty, of course, is price.
Okay, that's the view. Mayuresh, how should one position themselves for any big spike in crude? If it were to be more than short-lived, of course, OMCs take a hit, so do other crude sensitives like paints, etc. But would you look at, the likes of ONGC, Oil India, and even perhaps the pipe makers, because they get to lay down the pipelines? How would you really play this crude spike? Could there be some positives?
So, Nandita, I think in terms of the escalation and the sustainability in terms of the crude spike is something to be seen over the next few weeks. From an Indian context, unless crude crosses $85 a barrel, it does not pose much of a risk in terms of an outside risk as far as our fiscal numbers are concerned. Again, I think if the crude prices do escalate from the current level, even till 85, I think what really happens is a lot of companies which have probably built in inventories for the next 3 months with lower crude prices, they'll probably have to build in inventories with higher crude prices as we speak. And therefore, raw material input inflation for a lot of oil or crude consuming industries and crude derivatives as well, including paints, including tire companies, might just feel the heat if this is elongated or crude stays at higher level. Having said that, I think what really goes through in terms of upstream companies with elevated crude prices. Obviously, the realizations obviously remain better. And therefore, I think within the mix itself, is there a tactical trade, if I have to put it? I think upstream probably becomes a tactical trade, at least from a tactical perspective.
Okay, upstream becomes a tactical trade. But Mayuresh, are the markets really prepared for 120 on oil in the coming months? Do you think that's something that the market would be prepared for?
I think the market's not prepared for that. Nandita, absolutely not. I think that creates a huge dent as far as Indian fiscal numbers are concerned. But whether it goes to 120 or not, I think there are a whole host of factors, a plethora of factors at play here. And therefore, I think one really needs to wait and watch. It's too preemptive to probably have these presumption in place where the crude touches 120. But if it does, I think that does provide a serious issue as far as our fisc is concerned. It's not just India. I think a lot of oil importing countries to a large extent. And then again, as I said, a lot of sectors which consume oil as an input cost. I think their earnings might come under. But as I said, very premature to probably assume that oil might touch oil.
Sure, premature to assume $120 on Brent. But Peter, coming to you, some of the reports I was reading, this morning, some of the brokerages have maintained that, base case still remains at 60 because this flare-up could be temporary in nature. What is your base case on crude right now? And of course, I would like to ask you questions about gold as well, but go on and tell us your base case on crude first.
Well, first, I agree with you as far as the 60 handle because of the production increases that we're going to see, which is going to be quite dramatic over the next couple of months from OPEC plus. There's the first part and that relationship. So that could be pushed out as far as Q3 and certainly into Q4. But the caveat has always got to be, there are two major components to this. I've been following it for 40 years. First off, Nandita, as we've discussed many times together, geopolitics. That's the uncertainty. That's the elephant in the room. And this is a classic example. Second one is Mother Nature, as far as weather outages and what they can impact from crude, gas, and you name it, every other component as far as energy. So you've got something now that could really change the landscape in the short to medium term, dependent upon how long that this runs for. Let's hope that there isn't a run on it. But if there is, yes, crude will spike from here. And if it's not, it'll certainly, go back down, I would say, to probably that 65 to 60 handle over the next month or so.
Okay, so in terms of precious metals and safe haven rush into gold as investors turn more risk off. Gold had been consolidating right after hitting fresh highs, but do you see 3,800, 4,000 kind of levels? Now that there's renewed buying coming in.
Sure, it's up $50 today. It's at 34.50. I think, yes, no doubt about it. You'll probably see 4,000 plus by end of year. That's my sort of back of postage stamp, because I just think you've got too many key drivers. You've got a huge retail market involvement. You've got central bank buying. You've got uncertainty as far as tariffs. You've got a geopolitical shock. Then you've got the other side of it as far as inflation getting under control, the US dollar going softer. All of these components and yield, I think you're going to see cheaper rates. So I think all of these factors moving in, and the uncertainty as far as if Fed Chair Powell gets moved quicker than not, and Scott Bessent takes the role. So all of those factors, gold's got more upside certainly in Q3, but more importantly Q4.
Okay, 4,000 by year end. That's the view. But what about silver? 13-year highs. More spark left. Could you see more buying, or is it poised to consolidate?
No, I think it's more buying, and I feel as though you've had underinvestment, as we all know, over the last couple of decades. It's still that gold to silver ratio. It's still being crushed, and it's just over. It's probably about 95. I'm just working it out of my mind, but it was only in the last couple of weeks, Nandita, it was 100 to 1 ratio. Well, have a look at its long-term historical ratio, And, I wouldn't be surprised to go back to that 65 to 75 sort of relationship. So silver's going to have, I think, more upside. Naturally, technology, you're talking about jewelry demand, and of course, underinvestment in that whole sector and the use of it in manufacturing from, all points as far as componentry. So, yeah, silver's going to certainly shine in Q3, but it'll really come to life in Q4.
Okay, so Q4, both gold and silver are, going to see increased activity and perhaps higher highs. Mayuresh, how do you play this precious metal theme from a stock market standpoint? In terms of gold financiers, there's been some reprieve in terms of the draft norms by RBI as well. So would you look at the gold financier space right now, and how would you play this entire precious metal theme?
No, so as Peter was mentioning, I think once the risk off starts coming in, you've seen an obvious reaction happening on both gold and silver. And therefore, I think how long this escalation lasts will determine the moves that we are seeing from an immediate perspective as far as both these precious commodities are concerned. Having said that, I think when it comes to gold financing companies in the Indian context, with the tweaks that RBI has done in the recent policy, obviously, I think the LTV ratios have been changed. And therefore, I think with gold prices zooming higher, the immediate impact or the brace impact will be felt by jewelers first, because I think it becomes a little bit untenable to buy fresh jewelry at these levels, at least as gold or gold jewelry is concerned, or even the precious or the studded jewels. And therefore, I think the obvious choice for financiers would be that the volume growth should be reasonably good enough. You're expecting to see margins probably creep up with LTV rules that have got tweaked. The earnings profile should be relatively better as well. So yeah, I think you have to map between jewelers and gold financing companies. I think gold financing companies might do a tad bit better compared to the jewelers at this point.
Got your point. Mayuresh, they say tough times only throw up opportunities, right? Which are the pockets that investors should look for opportunities now? Given the correction that we've seen in the last few days, because till now we've seen the markets climbing all the walls of worry, right? Had the India-Pakistan conflict as well, and we've come back quite well from April lows as well. Given all that's happening, a retest of April lows would be off the cards, A, and secondly, in terms of opportunities in these tough times, where should one really look?
So again, Nandita, I think what really transpires is where earnings are going to hold up. And again, I think we have been harping upon domestic themes for a periodicity of time, and we continue doing so. Obviously, I think Iran and Israel is the latest news, but global demand supply still seems to be very, very weak. How does it come back? Still remains circumspect. The bond yields are still showing signs of volatility. And therefore, I think domestic focus sectors might actually continue doing well. Case in point, BFS as a space has nothing to do in terms of the global conflict. I think it's entirely domestically driven to a large extent, and therefore specific stocks within the sector might actually continue doing well. As a space, optimistic, but to a large extent, I think it might be consolidating at this point of time. But select stocks, whether they're large private banks or a few PSU banks, continue doing well. Domestic focused healthcare hospital stocks will continue doing well, absolutely immune to what is happening in the globe. The consumption story that we've been harping upon, in expectations of tax cuts and expectations of a better monsoon, we've seen the inflation print come far lower. And therefore, as consumption picks up over the next few quarters, select themes within that, select FMCG companies, select footwear companies, select apparel players might actually start doing well as the trends start picking up. And therefore, my own thesis is that domestic story where supply chains are not driven globally, but to a large extent locally. And even if there is a global scenario, I think it's far more diversified. And where the end demand remains domestically driven. I think these sectors that I'm speaking about and a couple of more will continue doing well. From a macro standpoint, to answer your first question, in spite of what is happening across the globe and what might happen either geopolitically or on the economic front as far as tariffs are concerned, growth is concerned, and inflation is concerned, the Indian macros shape up to be a tad bit better compared to the rest of the globe. And the micros in terms of corporate earnings, because of all these factors at play, being a largely domestic-driven economy, should largely hold up as well. So I think anything which happens in terms of risk-off, in terms of Indian equity, there is some element of a sharp knee-jerk reaction. In my opinion, that becomes a buying opportunity in key select sectors and key selects.
Fair point, Mayuresh. Let's also come get Peter in once again. Then, Peter, want to get in your thoughts on how you are viewing the dollar trajectory. From 110 handle, it is now sub 99. But how would you look at the dollar index in the wake of what's happening in the Middle East?
Well, I think you first off got to look at bond yields and have a look at the short end versus 10-year, and I think you're going to see again that push from President Trump really going to be on the throat of Fed Chair Powell very, very shortly. I mean, there's been a level of aggression from President Trump, and I think he's going to really turn up the heat if he doesn't see a rate cut. And he's had inflation under control, far better and far more closer to that 2% target. He's got fairly good growth numbers as far as non-farm payroll each month. And he's got a stock market that's only 1 or 1.5% from its all-time high. So he's saying, well, what more do I need to do? He wants a 100 basis point cut. So if that's going to be factored in, I would think you'd see it'd be short. It'd be a softer US dollar if you're going to cut rates by 1%. And do you see how many successive cuts, Nandita, by end of year? So these are all components that need to be fleshed out. And I would think you'd have to be relatively, unless it's geopolitical and it drives US, if this event at the moment is short-lived, then I think that the US dollar will continue its downdraft.
Okay. Well, of course, as you also mentioned, Trump has been ratcheting up pressure on Powell. In fact, he's called him numbskull and stuff like that. I'm again alluding to the JP Morgan report, where they said that if this conflict continues, US CPI could, go up to 5%. How much of a possibility do you see of that happening? And in that case, a rate cut would be completely off the table.
Oh, completely off the table. And you know as well as I do, if you see energy prices would just spike over $100 or even higher, if this was a really long drawn out process and it engaged numerous other countries, or no one knows the playbook to this. If prices spike and they stay up and they're elevated for quite a number of months, then that's going to drive inflation. We know that. That's what crude oil does, and that's global. So that's the issue, and that's the wild card in the whole pack. So no one's got a crystal ball to tell us where that's going. We've just got to look at the history and historical data to try and get some indication of what we see is ahead of us. And this is certainly unknown territory, but we do know that higher energy prices drive and quickly drive inflation.
Okay, what about US equities, Peter? Just a few days ago, S&P 500 was within, I think 2% or so from its all-time high. So even despite the tariff uncertainty, we've seen US equities holding out pretty well. What happens here on?
Absolutely. Well, if the first part of it is, yes, they're less than 2% from their all-time highs. The Dow, I think it's around about 1.6% after this morning's market. It was up, when I say that, US New York Thursday was up 0.24, the Dow 30 up 0.38 for the Nasdaq, for the S&P, and about a quarter of a percent up for the Nasdaq. So you're really getting very close. We understand what President Trump said, and you made that statement at the start. He wants to send letters out, and he wants to see a result from the tariffs. And it's just going to be, this is what you'll pay, and this is how it's going to work. So it's quite an assertive stance. And this is all the components. Howard Lutnick's got his hands full, and he's pretty much, I think, not very satisfied with the Eurozone and dealing with 27 different countries. And as far as a nation bloc, these are all components that are going to play out over this summer period. And I think it's going to be one hot summer.
Okay, one hot summer. Also talking about emerging markets, Peter, your thoughts on how India has held up till now? Of course, foreign inflows into India has also been pretty volatile. Do you expect flows to dry up here on, given the Middle East tensions, or would you expect them to focus on the long-term Indian story and perhaps keep on pumping in money?
Yeah, I travel to India quite frequently, and I love the whole energy, and I can't see it being derailed. I've listened to the Prime Minister. I've listened to, at conclaves. I've sat there and listened to your ministers. I'm understanding from, the infrastructure story as far as India. I buy into the military. I see the population. I see the entrepreneurial zeal. It's very addictive. And I can't see it being derailed. I think that China, and it was a comment that came out by a well-respected business fellow in the last couple of days, said that India is like China 35 years ago. It probably is, but I think there's far more upside for India than what there was for China. And I think certainly your best days are ahead of it, and this is certainly your century. So, yeah, roll on. No one's going to derail India. It's going to be very dynamic and a very, very great place as far as investment and opportunity.
Sure. I want to get in Mayuresh's thoughts on flows in the very short term. Mayuresh, we've, as I was mentioning, seen fair volatility when it comes to foreign inflows, right? Once again, we've seen, FIIs turning sellers. Of course, the long-term story is pretty, structural story is intact, and people FIIs would want to invest in this story, but from the medium term to small or short term perspective, do you see flows once again turning negative? How are you looking at the picture now?
So, again, I think if this escalates, hot money might move back to a certain extent, both in terms of gold and safe haven asset, which becomes dollar or dollar denominated assets. But I think it might be short term in nature, because what we've seen in the past, again, I think all these escalations that we've seen do not get long drawn, except I think Russia, Ukraine, which has again petered off. And therefore, I think markets start focusing back. Once a huge part of this is largely over in the next few days or next few weeks. In terms of global macro and micro dynamics. And therefore, I think with that picture in mind, even if there is a short-term, temporary, immediate impact for some of the flows, I think if you look at the global construct and in terms of mapping out which economies will do well out of the emerging pack, out of the developed world as well, as I said in my opening remarks, I think India probably stands out on a whole host of parameters to probably come out of all the global mess that we are into at this juncture, both in terms of growth, both in terms of inflationary data points, and in terms of expectations of corporate earnings, which are expected to come back very, very strongly. I think FIs, FPIs largely do not have much of a choice in large pockets of the globe, except India. So at least at some point of time, even if there is some short reversal, hot money getting reversed, I think the flows will return back to India very, very strong.
Okay, Mayuresh, given what's been happening, and of course there's this looming uncertainty when it comes to tariffs, ahead of July 9 deadline, as I had mentioned, Trump would be sending out letters to the partner nations and, perhaps, set out new tariffs. In light of all this, have you made any changes to your year-end view on the Nifty? Would you say that we could be muted in terms of returns?
No, not at all. Our own sense is that India better place. That's the basic thesis that you're working out with. And the second element is at the end of the day, with everything that's going around the globe, I think Trump can't risk, in my opinion, of having accelerated virgin tariffs, whether it's China, whether it's EU, or the rest of the economies as well. Ultimately, I think the US consumer is going to take a hit. The US corporate earnings are going to take a hit. And to a certain extent, even the tax norms that he's probably harping upon might actually increase the deficit to a certain extent. If the Fed is in no mood to assume that if all these things are taken into consideration, growth might come down and inflation might remain sticky, the rate cuts might not come off, which means the interest servicing on the balloon debt that US has might still continue. So in my opinion, I think Trump is not going to risk exaggerated tariffs, and therefore normalcy and sanity will return, which means that we are not changing our optimistic view nor our year-end targets for them.
Peter, on the tariff issue, would you concur? Trump cannot really afford exaggerated tariffs, and here on he would kind of mellow down a bit?
Well, when you say exaggerated, I'm curious to see how the China situation plays out, Nandita. And I understand it's 55% the US and 10% for China. Uh, One can't get away from the might of the US consumer. And nearly every manufacturing hub around the world needs consumption when you go to sell your goods, and they've got deep pockets, the US consumer. Now, he's going to have successive, he's looking at rate cuts, he's looking at tax cuts, and he's going to, I think, put more dollars in the spending power of the US consumer. So that's going to be one almighty market that naturally everyone that's manufacturing, regardless of country, is going to want a sector of their sales going to the US. So in a lot of ways, President Trump holds the baby, the bathwater, and he holds the towel. And he's controlling the deal flow at the moment. So I think we're a long way from President Trump being pressured. I think he's going to put the pressure on countries. And I think this is all going to play out again over this summer period. It's a very dynamic market at the moment. And I think he's going to give them one letter, and that is take it or leave it. If they leave it, they really are going to have to look at other markets. Yeah.
Sure. Last question to you really, Peter. India versus China, would you go with India despite the fact that valuations perhaps compared to China would be a little more expensive?
Every day of the week.
Go on, Peter.
Every day, and I hope that I'm here long enough, and I reckon by 2040 the Sensex will be at 200,000. So there is no doubt in my mind that the place to be, because you've got youth, you've got so many key drivers that are going to ignite the from a consumption base, and that's what everyone needs, consumption. India is the place to be, and it's going to be a very, very dynamic next 1 or 2 decades. It's an exciting time.
Sure, exciting times for India. With that, Peter, would like to thank you for taking our time and joining in and sharing your thoughts. Always a pleasure. And as this situation evolves, I look forward to more interactions with you on air.
Thank you, Nandita.
Thanks a lot. Mayuresh, a couple of more questions to you. Given in light of the tragedy that we had yesterday, do you expect travel to get impacted in any way? And in that sense, how should one look at the aviation stocks?
No, first of all, very, very unfortunate. I think it was extremely saddening. So, Om Shanti to all the passengers and the families. May God give them strength. Having said that, I think what really comes through now in terms of regulatory changes, what does ITA do in terms of more checks and balances in place? And what probably happens with Boeing in terms of the stock itself, the manufacturer of the Dreamliner, the engines. You'd seen in the past as well, the Neo engines had problems as well. And therefore, I think an entire overhaul is something that the industry and regulators across countries might actually do. Does that impact travel significantly? I don't believe so. Unfortunately, I think the incident yesterday was something that nobody was prepared for. But does it impact travel significantly in the next few quarters to come? I really don't think so.
Okay, of course, our prayers are with all those who've lost their loved ones in this massive tragedy. But last question really, Mayuresh, now do you think for investors who want to get into the market, is it actually not the right time? Should one wait it out, keep their powder dry? Also given the fact that equity mutual fund flows are at 1-year lows, right? So, in light of all that, for somebody who wants to invest now, what would your advice be?
If somebody is an investor to mutual funds, my advice will be that, as Peter said, and where I resonate, I think India is going to be the best placed market over the next 10 to 20 years. And therefore, carrying on your SIPs is absolutely essential into the market because it averages your impact cost over a periodicity of time. And it gives you those compounded returns that you probably look at compared to other asset classes. If you're a direct investor, obviously, I think the expectations in terms of corporate earnings improvement in the second half at the current juncture would probably mean that the markets would look for Q1 numbers for the quarter ending June and the quarter ending September, whether they are base building quarters, whether you're seeing signs of revival The quarter gone by was reasonable in my opinion. There were downgrades, but there was reasonability in a lot of sectors and a lot of numbers that have come through. And therefore, I think the markets are now penciling in valuations which are fair as we speak. But if corporate earnings improve because of the liquidity scenario created and the other enablers at place, my own sense is that any decline that comes through, qualitative leadership stocks in the few select sectors that I mentioned can actually do well. So I think keeping my positive outlook onto the markets, any knee-jerk reaction for whatever reasons that we are having right now, geopolitical, geo-economic or otherwise, can actually become good buying opportunities for select stocks within these sectors.
Sure, as they say, tough times threw up opportunities. That's what is being highlighted by Mayuresh as well. With that, Mayuresh, lovely chatting with you and getting your perspective in. Always a pleasure, and I look forward to our next conversation as well.
Thank you, Nandita. Always a pleasure to talk.
Thank you. Well, then, as we wrap up this, special coverage on the conflict between Iran and Israel, I'll point out what the markets are doing. We have come off significantly from the opening lows. Want to point that out. We were below that 24,500 mark at one point in time, but now we are at 24,672 or so. So it's a 200-point recovery from the day's low. But yes, we are seeing a weakness in the market. Yesterday was a down day, and today as well, in the wake of the escalating tensions between Iran and Israel, sentiment has taken a hit. Of course, we'll have to see how this unfolds, whether Iran retaliates, how this situation evolves, whether it's short-lived or whether it could have some long-term repercussions as well. These are some of the moving parts that we have to keep our eye out for. But we leave you then on that note. Thanks a lot for tuning in. Stay tuned and have a good day. Keep watching this space for the latest on the Iran-Israel tensions and the markets and a whole host of other corporate news. Thanks a lot for watching.